Gas prices are rising again. Inflation pressure is returning. Bond yields are climbing. And Wall Street is showing signs of stress. For many Americans, this is not just another economic headline. This is about the cost of driving to work, paying for groceries, covering rent, managing credit card debt, protecting retirement accounts, and planning for the months ahead. The latest data shows that energy prices are once again playing a major role in pushing inflation higher. And when fuel prices rise, the impact can move through almost every part of the economy. So today, we are breaking down what happened, why gas prices are rising again, how inflation is affecting American households, what this means for the stock market, and what ordinary people should watch next. Hello, and welcome back. Today, we are covering a major U.S. economic story that could directly affect millions of families, workers, retirees, small business owners, drivers, and investors across the country. According to the U.S. Bureau of Labor Statistics, the Consumer Price Index rose 0.6% in April, and prices were 3.8% higher than 1 year earlier. Energy costs played a major role, with the Energy Index rising 3.8% in April and increasing 17.9% over the past 12 months. The Food Index also increased, while shelter costs continued to move higher. At the same time, AAA reported that the national average price for regular gasoline was $4.51.3 per gallon as of May 17, 2026. AAA also reported earlier in May that pump prices were sharply higher than 1 year ago. This combination of higher gas prices, rising inflation, and market pressure is becoming one of the most important economic stories for American households right now. Let's begin with the basic question: what exactly is happening? The latest inflation report shows that prices are rising faster again. Inflation had already been a major concern for families in recent years, and now energy prices are adding fresh pressure. In April, the overall consumer price index rose 0.6% in just 1 month. That may sound small, but for inflation data, it is a meaningful monthly increase. Over the past year, the All Items Index rose 3.8%, up from 3.3% the previous month. That means inflation did not just remain elevated, it accelerated. The key driver was energy. The Bureau of Labor Statistics said energy prices rose 3.8% in April, accounting for more than 40% of the monthly increase in overall inflation. Gasoline prices rose 5.4% during the month, and over the past year, gasoline prices were up 28.4%. That matters because gasoline is one of the most visible prices in the economy. People see it every time they pass a gas station. When gas prices rise quickly, households feel it immediately, but the impact goes much further than the gas pump. Higher fuel prices can affect almost every part of daily life. When gasoline prices rise, people who drive to work spend more money just to earn the same paycheck. Delivery drivers, truckers, construction workers, caregivers, small business owners, and commuters all feel the pressure. When diesel prices rise, businesses pay more to move goods across the country. That can affect grocery stores, restaurants, retailers, warehouses, farms, and shipping companies. When jet fuel and transportation costs rise, airline tickets and travel costs can also increase. The latest inflation report showed that airline fares rose 2.8% in April, another sign that energy related costs may be moving into other parts of the economy. Food prices are also part of this story. The food index rose 0.5% in April, while food at home rose 0.7%. That means grocery costs increased during the month. The Bureau of Labor Statistics reported that 5 of the 6 major grocery store food groups increased in April, with fruits and vegetables rising, beef rising, and non-alcoholic beverages also moving higher. For a family already dealing with higher rent, higher insurance, higher utility bills, and higher borrowing costs, even small increases can create real pressure. This is why inflation is not just a statistic, it is a monthly budget problem. To understand why gas prices are rising, we need to look at the global oil market. The U.S. Energy Information Administration reported that disruptions to crude oil production in the Middle East increased significantly. The EIA said its May outlook assumes the Strait of Hormuz remains effectively closed until late May, with shipping traffic beginning to improve in June. The agency also said oil shipments through the strait are not expected to return to pre conflict levels until later this year. This is important because the Strait of Hormuz is one of the world's most important oil shipping routes. When shipping through that area is disrupted, global oil supply becomes tighter. When supply tightens and demand remains strong, oil prices usually rise. The EIA reported that Brent crude reached a high of $138 per barrel on April 7th, averaged $117 per barrel in April, and is expected to stay around $106 per barrel in May and June. That is a major reason why gasoline prices remain elevated across the United States. AAA reported that the national average for regular gasoline was $4.513 per gallon on May 17th. Earlier in May, AAA said the national average had risen sharply for a second straight week, and pump prices were about $1.40 higher than 1 year earlier. So the situation is not just about domestic demand, it is connected to international conflict, oil supply, shipping routes, and uncertainty in global energy markets. This story matters because energy prices can affect the economy in several different ways at the same time. First, they affect households directly. A person who drives 40 or 50 miles a day may be spending much more every week just to commute. For people in rural areas or suburbs where public transportation is limited, driving is not optional. It is part of daily life. Second, higher fuel prices affect food and goods. Most products need to be transported. Food moves from farms to processors, from processors to warehouses, from warehouses to stores, and from stores to homes. Each step uses fuel. When fuel costs rise, businesses either absorb the cost or pass it on to consumers. Third, higher energy prices can affect inflation expectations. If consumers and businesses begin to believe prices will keep rising, behavior can change. Businesses may raise prices earlier. Workers may ask for higher wages. Consumers may rush purchases before prices go up further. This can make inflation harder to control. Fourth, inflation affects interest rates. When inflation rises, the Federal Reserve usually becomes more cautious about cutting rates. If inflation remains too high, the Fed may keep rates higher for longer, or markets may begin pricing in the possibility of rate hikes. That is already affecting financial markets. Reuters reported that U.S. Treasury yields climbed sharply as investors reacted to inflation concerns and oil price pressure. The 10-year Treasury yield rose to around 4.599%, its highest level since May 2025, while the 30-year yield rose to around 5.131%. Higher Treasury yields can influence mortgage rates, auto loans, business loans, credit card interest, and the cost of government borrowing. For ordinary Americans, that means inflation can hit twice, first through higher prices and second through more expensive borrowing. Now, let's talk about the stock market. The latest trading session showed that investors are becoming more nervous. Reuters reported that global equity markets fell while bond yields rose. On Wall Street, the Dow Jones Industrial Average fell 1.07%. The S&P 500 fell 1.24%, and the Nasdaq Composite fell 1.54%. Reuters reported that the sell-off came as inflation concerns returned and oil prices added pressure to markets. This matters because millions of Americans are connected to the stock market through retirement accounts. 401k plans, IRAs, pensions, mutual funds, index funds, and brokerage accounts. Even people who do not actively trade stocks may still be affected when markets become volatile. Technology stocks had been supported by optimism around artificial intelligence. But Reuters reported that the S&P 500 and Nasdaq sold off after reaching record highs as investors shifted attention back to inflation, bond yields, and economic data. The concern is simple. When interest rates rise, the future earnings of companies can become less attractive to investors. Higher borrowing costs can also pressure businesses, especially companies that rely on growth, financing, or large capital spending. For retirees, this can be stressful. A market drop can reduce portfolio values, while inflation reduces purchasing power. President Trump has proposed suspending the federal gasoline tax to give drivers some relief. The federal gasoline tax is 18.4 cents per gallon, while the federal diesel tax is 24.4 cents per gallon. However, the president cannot suspend the tax alone. Congress would need to approve it. Supporters of a gas tax suspension argue that Americans need immediate relief at the pump. If gasoline is above $4.50 per gallon, even a small reduction can matter for families who drive every day. But critics raise two major concerns. The first concern is whether the full savings would actually reach consumers. If the tax is suspended, prices might fall, but not always by the exact amount of the tax. Market conditions, supply costs, refining margins, and retailer pricing can all affect what drivers actually pay. The second concern is infrastructure funding. The federal gas tax helps fund highways and public transportation. AP reported that the tax provides more than $23 billion annually for highway and public transit infrastructure. So policymakers face a difficult trade off: short term relief for drivers versus funding for roads, bridges, and transit systems. Now let's bring this down to the household level. Imagine a worker who drives 30 miles each way to work. If gas prices rise by more than $1 compared with last year, that worker may be spending hundreds of dollars more over time just to maintain the same routine. Imagine a retiree living on Social Security or a fixed pension. That person may not drive every day, but they still pay more when groceries, utilities, transportation, and services become more expensive. Imagine a small business owner who operates delivery vans, landscaping trucks, repair vehicles, or food service transportation. Higher fuel costs may reduce profit margins. If the business raises prices, customers may cut back. If the business does not raise prices, the owner absorbs the loss. Imagine a parent trying to manage rent, groceries, childcare, school expenses, and fuel. When inflation rises across multiple categories at the same time, there may be no easy place to cut. This is why the inflation story is so important. It is not just about Wall Street. It is about real decisions at the kitchen table. Families may delay travel. They may reduce restaurant visits. They may postpone home repairs. They may use credit cards more often. They may reduce savings. Some may delay retirement contributions just to cover monthly costs. And when many households do that at the same time, it can affect the broader economy. The most important question now is whether this is a temporary energy shock or the beginning of a broader inflation problem. If oil prices fall quickly, gasoline prices could ease. That would reduce pressure on households and may help inflation cool again. But if oil remains above $100 per barrel for an extended period, the pressure may continue. The EIA currently expects Brent crude to remain around $106 per barrel in May and June, which means fuel costs may stay elevated in the near term. The danger is that energy inflation spreads into other categories. We are already seeing pressure in food, shelter, airline fares, household furnishings, personal care, apparel, and education. The Bureau of Labor Statistics reported that core inflation, which excludes food and energy, rose 0.4% in April and was 2.8% higher over the past year. Core inflation is important because it shows whether price increases are spreading beyond volatile categories like fuel and food. If core inflation keeps rising, the Federal Reserve may have less room to lower interest rates. Markets are already reacting to that possibility. Reuters reported that traders increased bets that the Federal Reserve could raise rates this year as inflation concerns returned and Treasury yields moved higher. For households, this means the next few weeks are very important. The key indicators to watch are gasoline prices, oil prices, the next inflation report, Treasury yields, and any policy action from Congress on gas taxes. There are 5 things Americans should watch closely. First, watch the national average gas price. If it continues rising above the current level, household pressure will increase. Second, watch oil prices. If Brent crude remains near or above $100 per barrel, gasoline prices may remain elevated. Third, watch grocery prices. Food inflation is one of the most sensitive areas for households because it affects everyone. Fourth, watch interest rates and bond yields. If Treasury yields keep rising, mortgages, auto loans, credit cards, and business loans may become more expensive. Fifth, watch the Federal Reserve. If inflation stays high, rate cuts may become less likely, and markets may continue to face volatility. This is why this story connects so many parts of the economy: energy, inflation, interest rates, stocks, household budgets, and government policy. There are still several uncertain points. We do not yet know how long oil supply disruptions will continue. We do not know whether Congress will approve any federal gasoline tax suspension. We do not know whether companies will absorb higher costs or pass them on to consumers. We do not know whether inflation will ease in the next report or continue rising. And we do not know whether the Federal Reserve will keep policy steady or respond more aggressively if inflation pressures continue. That is why this should be treated as a developing economic situation. To summarize, gas prices are rising again, inflation pressure is increasing, and financial markets are reacting. The latest official inflation data shows higher prices for energy, food, shelter, and several everyday categories. AAA reports that the national average gasoline price remains above $4.50 per gallon. The EIA expects oil prices to stay elevated in May and June, and Reuters reports that Treasury yields and stock market volatility have increased as investors worry about inflation. For ordinary Americans, the message is clear. This is not just a fuel story. It is a household budget story. It is a borrowing cost story. It is a retirement account story. And it is a policy story. If fuel prices fall soon, some pressure may ease. But if energy costs stay high, inflation could remain a serious challenge for families, retirees, workers, and businesses throughout the summer. How are higher gas prices and inflation affecting your monthly budget right now? Do you think this pressure will be temporary? Or do you believe prices will stay high for longer? Share your thoughts in the comments. If you found this update helpful, please like the video, subscribe to the channel, and turn on notifications for more clear and reliable updates on the U.S. economy, inflation, gas prices, Social Security, retirement planning, and policy changes affecting everyday Americans. Thank you for watching, and we'll continue to follow this developing economic story closely.